Okay, good morning, everybody. I'd like to welcome you all to the Daily Energy Markets podcast. It is Thursday, October the 17th. I'm delighted today to be joined by Michelle Bachmann, Principal Analyst at Lloyd's List Intelligence, Victor Yang, Senior Analyst, JLC Network Technology, and Arne Lochman Rasmussen, Chief Analyst and Head of Research at Global Risk Management. Thanks so much, everyone, for joining us today. Michelle, perhaps I can start with you. We've got, some really good actually headlines on the bulletin today. Plenty there to focus on, updates on what's happening on the oil markets. In general, a bearish sentiment. Let's start with that angle. Despite, and your specialty is obviously, insurance, and looking at what's happening out there also in the shipping world, and of course, a very dynamic time it is for that sector. And yet, we see oil prices calm. All the concerns about geopolitics don't seem to be feeding into that. Are we seeing calm on the seas these days? And has the nervousness gone out of the market there?
Oh, good morning. No, I think the volatility remains, but the needle really hasn't moved in relation to the enormous tension and disruption that we're having in the Middle East Gulf. This morning, there was news of some of the bombing of some of the Houthis' strongholds where they keep their weapons on land. That hasn't moved the needle either. We had the Office of Foreign Assets Control sanction 16 companies and 23 tankers in their most aggressive response to their imposition of their sanctions since October 2019. And yet we have a flat oil price. And I think also the sentiments and the big picture that we got from the IEA yesterday with their annual World Energy Outlook, it all contributes to a very bearish outlook. And I can't see at this particular moment that we're going to see oil prices sort of come out of the range that they've been trading in for the last 6 months, despite all of the tension and the terrible developments that are happening in the Middle East.
Yeah, thanks very much, Michelle. Arna, good morning again. Let's get
Good
your
morning.
take on sort of your outlook. We're well into Q4 now. We've just started, but your outlook again for, I suppose, the demand supply balance, really, because, we've got both of those sides of the equation for oil in some uncertainty. On the supply side, will OPEC add, will they not add oil, etc. And of course, the demand scenario, which also continues to be, bearish, but also we see the US economy holding up, for example. What's your outlook for, let's say, the next 6 months?
I think it's that maybe the market has become a bit too bearish, especially on the demand side. We do see a lot of easing, monetary easing. The ECB will cut rates today. The Fed will definitely cut rates more. China is trying to ease the fiscal and monetary policy. They might underwhelm, but the effect might not be seen before down the road. Then I firmly believe that yes, OPEC Plus might add a bit more oil here at the beginning of December, but I think they will eventually postpone this plan about adding more oil. And then I actually do believe that we will slowly sort of edge towards the high 70s, maybe even touch 80 over the next 3 to 6 months. But if OPEC keeps on adding more oil, I don't think they will be able to hold the 70 threshold, and we would move below 70 in my view, talking to Brett. And I think the market is pretty nervous about it. You can actually go and look at the paper market, the financial market, and say, okay, what does for example, the option market tells you? It tells you it's very expensive to insure both against a big move in oil prices higher and a big move lower in oil prices. The so-called implied volatility is very high. It's actually similar to the level we saw a year ago when we had the Hamas attack on Israel. So the market is nervous, and actually in both directions. So it's very expensive to buy sort of protection for a sudden move in oil prices, and it also goes for oil prices in 6 months time, not just in 1 month time, and so on. But overall, I'm actually slightly positive, and we trade with commercial clients that do paper hedging, and we say when we are in this 70, 74 level, there's still a bit of backwardation. Then I think it still makes sense to hedge some of the exposure, and I think it's also we're quite active in the in bunkers, marine bunkers, and we actually see pocket of strength there. Something like high sulfur fuel oil is very expensive at the moment. VLSFO is starting to become more expensive as well. It doesn't go for the distillates; they're very cheap relatively to Brent. But we see these pocket of strength here and there.
I suppose that so the bunkering is that linked to the longer voyages that we're seeing as a result of this disruption?
It's part of it. That demand is actually there. The high sulfur is also due to that. I think the market has been surprised about the lack of supplies, especially from some of the new refineries, like the Dangote to the Al Zour refinery and so on. The supplies have actually been smaller than expected. And we're now going into the refinery maintenance period in the refinery sector, so this could actually intensify. It's certainly an issue we see here in the ARA, the Rotterdam area, but we also see it to a certain degree in Singapore that these fuel oil markets are relatively tight. You talked just before we went online here. You talked about the heat in the Middle East. That's actually quite an important driver for on the demand side. That a lot of the fuel oil is used for power air conditioning during the summer, and if the summer extend into the autumn, so to speak, then the power demand will stay high for fuel oil, and that's sort of competing with what's going on in the bunker industry.
Okay,
so there's
great.
mainly three: bunker, bitumen, asphalt, and then power. That's the sort of main demand factors for these fuel oils.
Thanks, Arne. Thanks. Well, Victor, good morning. Let's go to you. And I mean, Arne touched there on middle distillates, and of course, diesel and fuels like that. And of course, China has a big role to play on the demand for that kind of product. Victor, I'd like to start by asking you a more general question and maybe give us an update of your understanding of, obviously we've had these the stimulus measures in the last 2-3 weeks that gave the stock market a boost, that were deemed as quite positive, but everyone's saying how they really translate into consumer consumption demand. But also some criticism from last weekend of, new measures again announced for property sector, etc., but a lack of figures. The market is finding it hard to interpret how will this really trickle through, to really sort of boost confidence and consumption. What's your impression of the stimulus that we've seen in the last few weeks?
Yes, well, good morning. And yes, well, for the real estate industry particularly, we had thought about quite a few important measures, including the lifting of restrictions on purchase, sales. I mean, the central government authorized the local government to lift such restrictions. And there used to be a price limit on houses, apartments, saying that the apartment should not be sold below this price or above this price. But now they are trying to remove such restriction. This means the house prices can fluctuate in accordance with market demand and the value, so on. So this will be a great advancement. And the government has announced a plan to increase the retrofitting of 1 million apartments in villages in the city. In China we had the term villages in the city, which means a block of buildings inside the urban area. And the government plans to retrofit 1 million apartments. And for this apartment, the government will offer the owner directly cash to allow them to buy another apartment. This will
okay, and I mean, Victor, just to interrupt you there, and do you feel, on being on the ground there, that these incentives are, I mean, what immediate reaction are, not in terms of transaction, but is there a belief from your average person in China that this will be an advantage, that it's going to encourage that recovery, the start of the recovery in the property sector?
Yes, well, on the ground, the confidence is coming back gradually, but not all back yet. In September, for instance, in Guangzhou, there were more inquiry about apartments. Well, and there was an increase of people asking about the price. And so we expect the real estate industry to show some signs of recovery at the end of this year. And if we refer to the Ministry of Housing and Rural Urban Development, we expect some recovery in October. So on the ground, a lot of people are still holding the wait and see sentiment, but some people are already moving to make purchase, to make inquiries. Yes. So the sentiment is kind of improving gradually.
Okay, so that we might see that start to trickle through, and how that might impact other consumer demand. But of course, you've got the whole industry side of things as well in China, and that's export market, and how the US's economy doing there. We'll get back to that. Michelle, let's get back to you. I mean, you bearish sentiment overall for the oil market, but let's get into the nitty-gritty more about where tankers are, where the insurance market is looking. Now we're coming to the end of 2024, a very, very nervous time for the shipping sector from a safety point of view, from a geopolitical point of view. Have we settled in? Is the feeling that, from a rates point of view, next year will be more steady? We're kind of in a new uncertain period, but more of the same. We're not going to see an end to the geopolitical turmoil that we're seeing, and the market is adjusted.
Well, at this time of the year, the tanker rates will have what we call their fourth quarter seasonal increase. And we've seen that for two of the three main vessel types that ship crude. For example, Suezmax tankers, they're the ones that take 1 million barrels of crude. They have gone up from, I've got it here, they've gone up from $22,000 per day at the beginning of the month. They've jumped up to $42,000 per day. Wow. Aframaxes, which are slightly smaller, they've gone up also to $38,000 per day from the same level again. But very large crude carriers, they're the big ones with 2 million barrels per day, they haven't really changed. And that's because they essentially serve the Middle East Gulf market to Asia. And I think Suezmaxes and Aframaxes are more in the Atlantic basin and more affected by the Red Sea, which, as we know, has been more or less shut to a lot of the maritime traffic as a result of Houthi attacks on merchant shipping. So I think that kind of reflects the fact that there has been no seasonal uplift for very large crude carriers as yet, that it's a sign that demand is not really as strong as it should be for this time of the year. I mean, bear in mind, we're only in mid-October. It could still happen. But I do think that's very interesting. And at the rate for a very large crude carrier, which carries twice as much as a Suezmax, is more or less the same. So I think that's worth an interesting insight into the market at the moment.
Okay. Thanks, Michelle. Arne, I mean, let's talk a bit about demand, and let's talk about the US, in terms of the economy there and what impact and that's having on global macro sentiment. Yes, the US economy is still fine. The data out there is ticking along nicely. We've had the adjustment in rates so far. But there is a bit more talk now about, okay, we've had a soft landing, but there's people saying, well, hang on, there's still a hard landing to come. We've got third quarter results coming out as well soon. What is the mood and sentiment, do you think? I know you're in Europe, but is there a nervousness about the US economy that, all of this positive vibe is actually going to begin now to change, and that soft landing may not be permanent?
Certainly, that's always the case, that sometimes the market's a bit too laid back, and yes, the U.S. economy could still. There's a lot of fundamental issues in the U.S. economy. the debt build is not sustainable in the long term. But will it change tomorrow? Probably not. And then, of course, there is an election coming up.
Yeah.
I think at the moment the market is sort of buying into this Trump trade. It seems like Trump is gaining the upper hand in the election. You're seeing cryptocurrencies are moving higher. The dollar is going stronger. The banks are performing in the equity market. Sort of this Trump package, the ones you should be positioned for. Maybe some are buying into the drill baby drill Trump message, and that there will be a lot of oil after the election. I'm not sure that will be the case, but that's part of it. But it's also and that could be positive for equities in the short term if Trump wins the election. But I think the headache could soon return, because if he actually goes through with some of the taxes on international trade he's talking about, this could be a severe blow to the global economy. It could be a severe blow to the Chinese manufacturing industry, and I'm certainly concerned about that. It could push up inflation significantly in the US if it goes through with that, and then it is end of rate cuts. Unless, of course, Trump decides to take the independence away from the Federal Reserve, which he's actually been talking about. We haven't seen that for 50 years. We have to go back to the 70s. So yes, this could come back as a boomerang. But for now, it seems like the market is very optimistic. We have a lot of numbers coming out, reports coming out this week and next week, and we're back to that. It's more important what Nvidia do than the weekly numbers. But of course, it is the bellwether of the AI revolution. But yes, maybe the market has become a bit too complacent about the US economy, but it actually does look pretty okay. The labor market is actually recovering. Inflation is coming down. Wage growth is okay. So the purchasing power of the US consumer is moving higher. That actually goes for the whole world. That's actually one of the reasons why I'm sort of a bit optimistic on the demand side, is that the purchasing power of the consumer is going up across the world, because interest rates are going down, wage growth is relatively high, not too high, and inflation is coming down. So your real income growth is there. But yes, there's plenty of things that could go wrong in the US economy, and we know that financial markets can turn around overnight.
Yeah, I mean, we see the equity markets doing what they're doing now. Inflation rates are coming down, but of course, what's in that basket is always a bit misleading, because on the ground, all I hear about and all over the world is how expensive food is and how expensive rents are, so there's some kind of disconnect there, although one of the CPI, let's say, is this or that. Thanks, Arne. Let's go to Victor just to talk a bit about China and oil demand there as well next. But let's look at the survey question. What's weighing more on oil prices today? Is it China demand, which is the rhetoric of the market, a lot of the market in terms of conversation, or is it actually more concerns about the bigger macro picture, US, Europe macroeconomic concerns, along with China's? We had somebody on the program yesterday who said that the China story is actually not what's pushing oil prices into a bearish mode, because the commodities demand is quite strong, and that's what really tells us everything about China. So is it time we started looking west for the blame on why oil prices are bearish? So we'll have a look at these responses there. Victor, let's talk about China demand and oil demand. We saw in the third quarter various volumes coming in. Of course, China buys when oil is cheap, and the outlook looks good for China in that sense. What is the plan there on more buying for crude and expectation on that front?
Yes, well, when we look at the latest data on September import, it was an average level. Yes, well. So we will not say demand is so weak from China. It's just not as strong as expected. We can put it that way. And for the coming 2 months too, we just expect average demand from the country, not significant change. And for now, the crude price is still relatively high, and it's not a good timing for the country to stock up on crude yet. So when we look at the rigid demand and when we look at the country's refinery throughput, well, we do not expect significant change in the coming 2 months.
What about, Victor, from Russia? What kind of Russian crude volumes are coming into China at this point?
And in August, we had a breakdown for August imports from Russia, official data. And the imports from Russia actually surged. And imports from Saudi Arabia dropped quite significantly because of larger price difference between the two grades. There was a larger discount, but in August, the price for Saudi Arabian barrel went up, and the price difference widened between Russian and Saudi Arabian barrels. So the country actually increased purchase from Russia. But for now, the demand for Russian barrels has gone up over the past 1 to 2 months. And the premium, on a DES basis in Shandong province in China has kind of surged. In early September, it was still trading on a discount of $0.3 per barrel against 1 month Brent. But now it's trading at a premium of $0.5 per barrel against Brent. So the price has kind of jumped. And so this could have kind of impacted demand in the coming months too.
Okay, good. Well, you mentioned that China is not buying too much now in general because it's waiting for crude to get cheaper. But I mean, yeah, of course it could, but we could see a swing totally the other way, couldn't we, if things heat up in the Gulf. Michelle, just back to that. Let's talk about sanctioned crude and dark fleet and we're reading articles that's just increasing in volume as time goes by. Arne just mentioned if Trump gets in, we're going to have a lot more action and perhaps on sanctioned crude, more enforcement. We've seen that sort of retreat a bit, whether it's Argentinian crude, whether it's Iranian crude in the last few months. Again, what's the outlook there from your perspective on that and what might be doing to market sentiment and rates?
Well, the interesting thing about sanctions and the dark fleet is that despite the imposition of designations and blacklisting, these tankers are still trading into China. So the vessels are often technically deficient, very dangerous, but the imposition of sanctions, especially from Europe and the UK, has no impact on whether or not they can call it China. And China's really become obviously the major destination for sanctioned crude, especially Iranian crude. Most of the 1.5 million barrels per day that we see ends up being shipped into China. And whether or not those ships are sanctioned, they're still making their way. The crude is discounted, and they seem, I think 70% of tankers that are sanctioned still continue trading, and they find their market in China, despite the fact that some of these vessels, I just did some work this week looking at the piping and the underpinnings, and I found that insurance protect P&I coverage for some of these tankers. I tracked it down to a UK incorporated company that claimed it was dormant, and the owner of the 100% shareholder was an Iranian guy in British Columbia who said, look, this is fraud, that they have used my passport and my details, and I don't own this company at all. And yet that tanker was importing 2 million barrels per day, so 2 million barrel cargoes into places like China, just tick box exercises. So there's lots going on in that world of the underbelly of trade, really, bringing in crude from Russia and Venezuela and Iran to markets in Turkey, China, and India.
Yeah. And I mean, if and there has been some talk that Biden last week banned one shipment and put a new restriction. That's probably a pre-election kind of maneuver. But there is, talk again that China might be getting nervous that may not get its Iranian crude in full as time goes on. Where would China turn to if that did happen, if we started to see some restrictions on some of that Iranian crude going forward?
I actually believe that won't happen, that the Iranian crude will still make its way to China. What we do see is that the buyers of crude are buying it on what we call CIF terms instead of FOB. So they're not taking any risk in terms of chartering the vessels that are bringing it to China. They're just saying to the suppliers of the crude, look, we'll buy it cost insurance freight. Once it arrives in the port, then we'll take ownership of it. So they're mitigating that factor. For the last 5 years, despite the imposition of sanctions, trade flows have been uninterrupted. So I don't think, no matter how much rhetoric we see in the lead up to the US election, that's going to result in any interruption to supplies of Iranian crude.
Okay, thanks, Michelle. Arne, I mean, again, on the same point of not sanctions, but, we've got all this sanctioned crude flowing. We have, obviously the OPEC crude that's being held off the market, but as we said earlier, is expected to start to trickle through. We've got a headline today, return of Libyan exports weighing on the European crude market. This overarching sort of feeling of plenty of supply and non-OPEC supply from the US and Brazil, etc. How do you think this is impacting OPEC's thinking? I mean, there's been a lot of talk about Saudi now, saying it wants its market share back, whether from other OPEC members or non-OPEC. Do you think we're going to see a change in that dynamic as next year comes into play?
I think we've already seen a change that the Saudis are trying to sort of push the quota busters harder this year. Yes, I think if we look 1 year ahead or maybe 2 years ahead, the OPEC Plus will be in big trouble. It's not sustainable, this cartel. There'll be so much spare capacity. They will have to lose so much in market share that in the end this cartel will break up. It's just a matter of time when it will happen. It will probably not happen next year, but maybe in 2 years. I remember I said this also I think at your small conference roundtable discussion in London in February this year, and people were sort of shocked about this. But I think this is what's going to happen. You cannot have. I think the International Energy Agency yesterday talked about 8 million barrels of spare capacity. Is that really sustainable? Will the UAE accept that they cannot really add to production, even though they have plenty of spare capacity just standing idle today? But I think, of course, the OPEC will try to push this bay as long as possible into the future. But it is inevitable that one day this is not sustainable anymore, and then oil will actually become a free commodity, and I think that's the best for the world, actually.
Yeah, a real market, as they say.
A real market, indeed.
There's what's weighing more on oil prices. Okay, China's still blipping a little bit above the rest, but I suppose it's all of the above. Victor, just to go back to you to close for us, perhaps at the beginning of this year, at the start of the year, China declared all its refined product export quotas in one go. Do you expect we're going to see the same from the country as we go into next year from a refinery point of view? What interest would there be for that from both independent and on independent refiners in the country?
Well, at the beginning of the year, the country actually announced the quota on crude import at one go. But as for the export to refined products, it was released in several batches. Now we had the third batch announced in September, and which is really the last batch too. And when we talk about the exports of refined products, we usually refer to gasoline, diesel, and jet fuel. And the quota on the three products in combination for 2024 went up by less than 2 million metric tons. for 2024. Right, about 1 million, yes, 1 million metric ton for 2024. So we do not expect it to be changed significantly yet for the coming year.
For the coming year. So I know you said that's what you'd expect next year, the same kind of volumes.
Next year, yes, would be, well, there could be a small change, but not significant change. Yeah. And so for now, SOE is under pressure to export more products at the end of the year. And they have been heard to apply for more quotas on export. Yes.
Okay, and Victor, just before we let you go, what about the manufacturing sector in China in terms of how that is performing? Obviously we see how copper is doing, how diesel is doing. Are those reflections on what's happening? Obviously the Chinese economy is making a shift to a service-oriented, but that's obviously more of a medium-term goal. Outlook for the manufacturing sector in the next quarter or two?
Well, the manufacturing, conventional manufacturing is not recovering very well this year. And for a lot of industries, they're still struggling to survive. Some companies, when they're engaged in conventional industries, and the government is now trying to give them a boost, particularly private companies, to ensure that they are playing in a fair field and a level playing field.
Yeah.
So we expect to see more policy support from the government to give industry a boost. Yeah.
Okay, and of course that's going to depend very much on the demand from elsewhere for those goods, isn't it? And that's a whole other question, which we may see some dynamics on once Trump comes in. But also Europe, and I wanted to go to you. We were talking about what Trump might do in trade with China, but Europe's had a couple of measures in the last month on the EV front as well, sort of following that pattern that the US has been taking. So yeah, fun and games. But thank you so much to Michelle today, and Arna and Victor for joining us. Coming up later today, we've got a halftime talk with Harry Chirangurian from Onyx Capital. Again, talking about China stimulus and many other things, including the US crude market and some technical positioning there on the oil market. So well worth a watch. Thank you so much, everyone. Have a great day.
Thank you.
Thank you. Bye-bye.